Hello, welcome to Pensions in 10 with me, David Brooks, and my colleague, Sadhbh Lynch. This week, we take a look at the interest rate cut for the Bank of England. We take a look at the regulator's latest guidance on how trustees can manage market volatility. And I give you an update on a investment fraud summit. Okay, so the first story we want to look at today is the news from last week that the Bank of England have cut base rates, which I suppose could be good news for pension schemes, might be bad news, but can you fill us in on what you think is the impact on DB pension schemes?
Yeah, of course. So last week, I'm sure everyone's quite aware that the base rate was cut from 4.5% to 4.25%, so a 0.25% cut. And usually for pension schemes, this might be seen negatively. So the lower that the interest rate is means the lower discount rate that you use on your liabilities. So when you look at your liabilities on a present value basis, when the interest rate is lower, so the base rate's lower, this means that your present valued liabilities are higher. So that can be sometimes concerning for pension schemes. But obviously the landscape of schemes has changed throughout the past few years. So if you look at where we are today, most schemes are very well funded versus historical averages, and also they're quite highly hedged. So what this means is when liabilities increase because of changes in interest rates, that also means that matching assets will also increase. So some of that should be offsetting. So increased liabilities, increased assets, overall their funding level should stay relatively consistent, which is good for schemes. Also, when you see a reduction in interest rates, as we've seen over the past week, it kind of indicates an economy going towards stability and going towards growth, which is obviously good for pension schemes' assets. When there's growth in the economy, it means that all of their corporate bonds, equities, will hopefully be performing well into the future, which is very beneficial for schemes. So why did this interest rate cut happen? So there was lower than expected inflation within the UK in March. And there's also been some global economic uncertainty, so from Donald Trump's tariffs, among some other things. The inflation was caused by, or the lower than expected inflation was caused by those tariffs, partially. So when there's tariffs in the US, that means that there's some trade in other countries that won't flow through to the US. It will now flow through other countries. So as there's increased supply of that trade, we expect that imports should be relatively cheaper as they want to find other countries to sell those products to. So that kind of signals a lower than expected inflation rate. And then also lastly, some of the members in the committee who set that base rate actually wanted a deeper cut. So rather than going to 4.25%, going to 4%. So that signals that in the future, we expect some more cuts to be on the table as well for pension schemes.
Great, thank you. Okay, so the next one's for you as well. Thank you. So the regulator has issued a short bit of guidance around what trustees should be doing, given some of the volatility in the markets. This was a couple of weeks ago. So while we didn't deliberately not do it, we've been covering lots of the sort of the governance around investments and Trump's tariffs. We did a podcast with Matthew Downey looking at some of the impact and what trustees should be doing, and I think we've mentioned it a couple of times anyway, sort of the volatility that's going on. So just from your perspective as an investment consultant, what do you think is in there that trustees might have missed, or that's also useful to know around how to manage volatile markets?
Yeah, so I think, as you correctly said, a lot of things have already been mentioned. We went through scheme liquidity, investment strategies in previous podcasts. Two sections that I thought were particularly interesting are, first one is investment opportunities. So when markets are volatile, usually we're concerned about risk. So we're trying to make sure we protect ourselves. We don't really consider the opportunities that volatility can have for a scheme. So one of them was to monitor investment opportunities when you see these market conditions shift. So one example of this that I think is particularly relevant is if we look at credit spreads. I know I spoke about these a couple of weeks ago, but if you look at corporate bonds, so at the beginning of the year, they had very tight credit spreads. So the extra return you got on lending to a company rather than a government was very small. Due to this market volatility, those spreads have widened. So the amount of extra return you get from lending to a company has actually increased because there's more volatility in the market, it's inherently a bit more risky. So now, if a trustee was considering going into corporate bonds, it might be a more attractive time to go into them now because the prices of those corporate bonds have come down versus the beginning of the year. So that's just one example of some opportunities that can arise during market volatility. But it's always important to just kind of keep an update on what different asset classes are doing and when might be a good entry point for a scheme, especially if you're changing into a new asset strategy. The second one that I thought was interesting was more focused on DC schemes. So I know we usually focus on DB schemes a lot of the time because that's what we work in. But for DC schemes, they mentioned to track member activity. So if you see that your members are increasing their withdrawals or transferring some of their assets to cash, it might actually signal that the members are concerned. So they're taking money out of these risky assets and putting it into a safer asset, so cash. And TPR have advised that you should encourage your members to seek financial advice before making any of these big decisions, as when you take money out of a risky investment and move it into cash, it solidifies that investment loss. So if a risky asset had a bad performance and you remove the money from that pot and move it into cash, it can actually solidify those losses. So just making sure that members are aware of the implications that this can have and offering them any advice that they might need or asking them to get financial advice is what TPR have said. Okay, Dave, so I know there's an investment fraud summit happening today. Do you want to talk us through what they're going to be discussing?
Yeah. So we're recording this on Monday. You won't see this until Tuesday morning. So at 4 o'clock on Monday, there's going to be an investment fraud summit, which has been organised by the Investment Fraud Committee, which is an all-parliamentary group, which has a different angle on sort of fraud and scams than we've seen in the past. So a lot of the focus from a lot of the industry groups have been on how to prevent scams from happening, which is obviously very important. So the Pension Scams Industry Group are involved with this event as well, and so looking at the ways of informing people so they don't fall victims to scams, and helping intermediaries and professional firms, much like ourselves, to be able to recognise the signs of scams as well and be sort of on the front line to stop them from happening. The focus of this summit is a bit more on actually trying to help the victims after it's happened. So unfortunately these things do happen. People are hoodwinked into making poor financial decisions, but either by sort of financial advisors that aren't acting ethically, can't speak today, or even scammers literally attacking people. But then at the end of the day, they could lose all their pension money, lose other investments. But then sometimes the payments and the structures that the scammers and the criminals have put into place create tax charges, and those tax charges often will fall on the victims of the scam already. And so really the main focus on this summit, this couple of hours summit, is to talk about how HMRC should be doing more to try to perhaps have a slightly softer approach to the victims and appreciate that they've already lost so much, and if you're adding on further debts that they now need to pay to meet the tax charges that HMRC have lost, isn't perhaps the nicest thing to do, or maybe not the most appropriate thing to do for those people. Even the Victims Commissioner has also spoken about this recently to say that they think some of the activity that HMRC have taken hasn't been correct and it shouldn't have been the way it works. And so there's two aspects to this summit. One is looking at sports professionals that are often targeted by advisors, but also the pension scams sort of industry that's happening there as well. And I think there's an asymmetry as well. There's a lot of effort to try to go after the victims and get the money out of them, but often we're not seeing the prosecutions to those who are actually perpetrating the scam in the first place. And I think the focus should probably be weighted towards the actual scammers rather than the victims. So I'm sure we will be reading over your cornflakes this morning as you consider watching Pension in 10. You might have read about this already in the Pensions Press, but we wanted to make sure that it's brought to light that this stuff is happening out there. And so if you're a pension scheme wanting to communicate to your members about scams, you can also say, about the victims. If you become a victim of the scam, the HMRC may come after you, but there are people out here that are looking to bowl for you as well. So really, really useful, really interesting to know about.
So thank you for listening to this episode of Pensions in 10. Make sure you tune in next week to hear Dave again present Pensions in 10, and subscribe if you want to make sure that you get updates on this every week. Thanks.